I was recently doing a little presentation for about 100 aspiring apartment investors, and a friend of mine caught the whole thing on tape. And when I was checking out the replay, I thought there was a lot of really great nuggets. So I wanted to share that with you. If you're a new and aspiring real estate investor and hoping to get into multifamily at any time in the next few years, you need to watch this video. So without further ado, here's me presenting in Denver.
A 4-plex, a 5-plex, a 16, or even an 83-plex. So there's a lot of ways you can do this. Who's got $5 million in the bank right now today? Raise your hand if you got 5. Okay, I don't, so I'm going to put my hands down. But I can still buy $5 million properties. How come? Leverage. What'd you say? Kim? Leverage.
Partnering.
The value of the unit. What else can I do to buy a $5 million property without my money? Partners? What kind of partners?
Money partners.
Money partners? Good.
Credit partners.
Credit partners? Awesome. So there's a lot of ways. So today I'll go through the 6 apartment buildings that I've purchased since 2008. I'll kind of go through them. I'll also talk about a reposition that I did in 2007 to make the owner $2 million in the pocket. It started at a $2 million property and it turned into a $4 million property. It took 1 year and he has almost netting $2 million in his pocket. Is that a good thing or a bad thing? Is that a good thing or a bad thing? All right, let's get started. So here we are today. Why are you here? Because you probably want cash flow? Because you might want depreciation? Raise your hand if you want depreciation. Raise your hand. Raise your hand if you don't know what depreciation is, please. Okay, so perfect. I'm glad at least one person said they don't know. Depreciation is a way to write off part of your property so that you don't have to pay tax. What if you made $200K this year and you didn't want to pay taxes on $200K? Well, you could buy a $5 million property and pay no taxes instead. Cool stuff? Yes. All right, let's keep going. Equity. Who likes equity? Good. Appreciation. What is appreciation as opposed to depreciation? Are they both good? Yes. They're both good. All right, so appreciation, there's a couple ways to do this. One is if you buy a house and you wait 10 years, is it worth more or less? Is it worth more or less in 10 years? More. Great. All right, perfect. And then another reason is you might be here because you know that real estate, and specifically multifamily real estate, is a very safe asset class, a very safe place to put your money if you have the money. If you don't have the money, don't worry, we'll teach you stuff also. And who wants to retire early? Please raise your hand. Okay, that's about 80% of the room, so that's great. All right, here we go. I need you to be super, super honest with me right now. Really, really honest. Raise your hand if you think you're going to get started in multifamily, legitimately in large multifamily, 6 to 10 years from today. Please raise your hand. 6 to 10 years. No hand. One hand? Good. How about 3 to 5 years? Who says, I know within 3 to 5 years I'll buy my first huge multifamily property? Nobody. 1, 2, okay. All right. How about 1 to 2 years? Who's definitely going to be involved in 1 to 2 years? And this means not the first 11 months. Okay, good 40% of the room. That's where most of you guys are, is 1 to 2 years. Thank you for being honest. Who's going to get started today or is already doing it? Awesome, I love that. That's another 20% of the room. Most people, we have a meetup group. Who didn't know I had a meetup group? 4 people, 5 people. Awesome, I'm glad you're here. I have a meetup group and it doesn't suck. So on the 3 to 5 years, so we've actually put together a questionnaire and put it out to everybody. Well, we offered people for a couple weeks. We were saying, if you would like to get into multifamily, and the answer is yes, when do you think you're going to get started? Almost everybody says 3 to 5 years. Guess what would happen if you did your first big deal today? Anybody have a guess? If you did your first big deal today, what would happen? You would retire before you ever got started. Thank you. All right, so why do people say that they'll get ready in 3 to 5 years? Because they don't have enough. They don't have enough. All of these things holding them back. Lack of experience. I don't have credit. I need to fix my credit for the next few years, and then I'll get started. Then in 3 to 5 years when my credit's fine, then I'll do the 1 to 3 that it takes me to retire, right? So all these lack ofs. What if I told you you didn't need any of these things? Would that be a good thing or a bad thing? Would that be a good thing or a bad thing? Good. All right, let's do it. So for those of you who said 3 to 5 years, let's talk about Michael Blanc. Does anybody know who Michael Blanc is? Awesome, that's a lot of people. So Michael Blanc is a podcaster, he's a multifamily investor, and he also has written a book. He talks about this law of the first deal. The law of the first deal is exactly what I told you before. At the day that you close your first multifamily, you're usually retired within 1 to 2 years. 1 to 2 years, and he's actually, on his podcast, he asked, I'm trying to think, he's probably got around 100 episodes, and he asked every single person how long it took from the day that they did their first deal to the day that they replaced, what is retirement, replacing all of your debts with passive income. So all of your old income is totally replaced, and you're now retired. Do you know, I have to read this, guys, do you know the most common word, oh yes, that I hear from people who have started in multifamily already? And this was supposed to, the second part was supposed to show up last. I was going to ask you, but what's the most common thing that somebody who is now today in multifamily that they say? I wish that I would have started. I wish that I would have started. I wish that I would have started. Thank you. Okay, after today, I expect that you guys will believe in your minds that you can start sooner. So here are some paths that you can take to be into multifamily. And these are all legitimate paths. Number one is that you can go to the School of Hard Knocks. Is the School of Hard Knocks bad? No. The School of Hard Knocks is totally fine, and a lot of you will do it, and that is an okay path. There's a good chance that you'll be in a really good place, and there's a good chance that you'll actually lose some money or do what Rod Cleef calls as, what does Rod Cleef call it? Who knows? Anybody listen to Rod Cleef? It's called a seminar. It's called a seminar. It's a paid seminar. You'll learn something. So he doesn't talk about it losing money. It's not a bad thing. It's a seminar. It's a learning experience. And it's okay to take the School of Hard Knocks if you guys want to take that path. It's okay. The next one is a mentor or a coach. Who in here has a mentor or a coach? Please raise your hand. Awesome. Are these multifamily coaches? Raise your hand. Okay, great. Who are you guys as multifamily coaches?
Michael Blanc.
Michael Blanc? Awesome.
Adam Adams.
That's funny. Who else?
Susan Lester-Lyons and Bill.
Who else has a multifamily coach that they like to say the name? I know Michelle's in here. Don't you have Brad Sumrock? Yeah. Awesome. There's a lot of great coaches. So this is a path. It costs you, but I actually don't even want to say it costs you. The expense that you'll pay to take a multifamily course is probably anywhere from 20 to 50 or 60 grand. And if you're going to retire in 1 to 3 years anyway, it's not really an expense. It's what would you call it? An investment. Okay, so the next one is being passive. So this is something that I don't hear enough people talk about, is how being passive can actually help you to be a multifamily syndicator. Who doesn't know what syndication means? It's okay, I just need to know. Okay, just a couple. Syndication means that you have a sponsor or somebody who finds the deal and will manage the deal, but brings in passive investors to fund the deal. So if you really, really want to get to somewhere and you have some money, you can go to the School of Hard Knocks and just do it yourself, and you might win, you might lose, and it's okay. I think you probably win, even still, if you're doing the School of Hard Knocks. You'll learn a ton, at least on the first deal. You can do a mentor or coach. It's going to cost you money, so if you have money, that's another thing. Spend the money, learn everything that you need to do, and then just do it yourself. Or, by being passive, there is something called a private placement memorandum. It gives you an opportunity to invest in somebody else's deal, somebody else who's already done it, somebody else who already has the attorneys and everything in place, the property management in place. And what you would do is you would give them anywhere from $25 to maybe $1 million for that deal, for them to be able to perform everything for that deal, right? And what you'll end up doing, and what my suggestion is not to be, in all of my deals. It's to look at everybody that's out there, Michael Blanc, Rod Cleve, Brad Sumrock, these people that are doing some big things and that have a good track record of making money for their passive investors. Now, what would happen if you had 200K and you went 50 in Brad's, 50 in Michael's, 50 in another couple people's? What you would learn is the way that they're giving you the numbers every single time that they do a deal, every quarter or every month, they're going to give you quarterly reports that basically show you all of the income, the expenses. You'll be able to ask questions. You'll see how that deal sponsor, Brad Sunrock or whoever, you'll see exactly how that sponsor communicates with investors. You'll eventually steer toward 2 or 3 people that you like the most, and you can keep going that way, even with 25 grand a piece, until you learn and know everything. And definitely you have some deals in your belt. Basically you have hundreds of doors that you own, a small part of, and you add credibility when you're going to go raise the money from other people. Does that make sense, yes or no?
Yeah.
Okay, awesome. All right, so there's also teaming up, which is a fantastic way. I would suggest 100% if you team up with people that are doing this, don't just play the game of hard knocks. At least one of the people on your team should be taking a real mentorship, okay? But if you're going to be teaming up, there's a lot of ways to do it. In the back today, so Brad, not Brad Sunrock, but Brad Lowry is our engineer. He does all of our underwriting. So he definitely takes education with us. Brad, raise your hand. All right, so this brilliant man over here, I don't want to underwrite every property. That takes time. Not everybody is a numbers guy. Not everybody's likes to just look at the computer all day. But if you have somebody who really has that skill set, that underwriter doesn't necessarily need to do all those other things. So if you're just a brilliant genius and you can learn how to underwrite real fast, you can work with somebody as a partner, own part of their deals, and what you'll end up happening is a track record and be able to close on more and more deals, and eventually you can just go off on your own. So there's a lot of paths. We'll just go shortly. Acquisitions. If you're super good at finding single-family deals, you'll probably be way better at finding multifamily deals. Do you know why? Competition. How many people in this room have flipped a house or own a rental? Please raise your hand. Flipped a house or own a rental. Look around. How many people own a multifamily unit over 10 units? Raise your hand. It went from about 50 people to 2 people, just like that. Your competition goes down. So if you're really, really good at acquisitions, don't worry. You're going to be able to be even better with multifamily acquisitions. A credit partner, let's just say you had stellar credit and you wanted to just sign on the loan with a sponsor who is already doing things. You don't have to do anything. You don't have to underwrite the deal. You don't have to find the deal. You don't have to anything except sign on the line. There's other ways to partner. We'll go through them. There's earnest money deposits. So let's say you only had 50 grand in the bank and you didn't feel comfortable for one reason or another to put all of that 50 into a sponsor's deal for basically as a passive partner. Maybe you just wanted to be more active, but that's all you had was 50 grand. You go to a sponsor and you say, hey, the next time you have an earnest money deposit, let me put the earnest money deposit up for you and give me the first right of refusal to be a part of that deal on the general partnership. So there's 2 things, GP and LP. So the general partnerships is going to be all the people that run the deal, and the LP is going to be all the people on the deal that sit back and collect checks, okay? So if you want to just be an earnest money deposit person, and we've used earnest money deposit people as well, then you tie up your money for probably 2 to 3 months. You put it down. The deal closes about 2 months later. You either have an option of getting your money back plus interest or staying in the deal as a general partner. So that's another really good way to do it. And then the last one is just to sponsor deals, which is what we're doing. And if you want to be creative, get your mind out of the box. So here's the thing. Before we move anywhere farther today, You really have to take this to heart. This is the most important slide that we have, okay? The other day, I posted something on Facebook, and a lot of people were asking me questions about the deal. And this one person said, "How did you do this?" And I gave him an answer. And his immediate response was, "Yeah, but what about this and this and this and this?" Basically saying, "I promise you, Adam, that you can't do that because there's all these things that I've heard about, and I hold them true. I know that there's no out-of-box way to do this." And that's fine, but for that one person who didn't open their mind to new strategies that were available, they'll probably never do a deal like this. So for you guys, start to think creatively, start to think at the bottom. There's two things, Robert Kiyosaki talks about this. Some people say, "I can't." When something comes up, it's like, "I can't." But the better way to say is hurry and get that out of your mind and say, "How can I?" Please, can you say this with me? How can I? 1, 2, 3.
How can I?
Thank you. All right, so terms. Here are some of the creative ways we can do this. The first things we want to talk about is creative financing, and that's going to come into all these things right here. The first one is owner finance. Owner finance is if the owner becomes a bank. Usually this is that the owner, they can do what's called a wraparound mortgage, or they could just literally be the bank. So if they own the property outright right now, then they can just do a 100% loan. Always ask for a 100% loan first. Don't start with 80-20 or anything like that. Always start with 100%. Okay, so there's owner finance, and there's two ways to do that. One is a principal only. The next one is the interest only. And the way that's not on there because I don't like it is amortization. So first off, you say, "I want to buy your $5 million property." What I'll do is I'll split that up into 200 equal payments over the next 200 months. I'll give you this much, and this is principal only. That's your very first way to do this. Principal only. What's first? Principal only or interest only? A little louder. What's first? Principal only or interest only?
Principal.
Okay, so what's interest only? That's when you basically, principal only is like you basically pay the certain amount, only principal, for a certain amount of months until it's gone, and there's no balloon payment. And interest only, there's probably going to be a balloon payment, or you would literally be paying this for the rest of your life. So eventually you want to refinance an interest only loan, and you start at the lowest amount possible, and you let the seller work that up for you. You don't say, "Oh, I can give you 10% automatic." You just say, "What do you want?" And they say this. You say, "I don't know if it's going to work. I would do this." And then you start to negotiate. Does that make sense at all? Yes. Okay. So seller carryback is kind of like seller finance and owner finance, except you're basically going to get a loan from the bank, or you can assume the loan. But you're going to have a bank loan, and they're going to carry back a portion of the balance. They'll just carry back a portion. It's still owner finance, and you're still going to start with principal only and then interest only. And if you have to do it, the third option that's not on there is amortization. All right, so there's also something called a master lease. My company, we buy large multifamily that have at least 90% occupancy. They're already cash flowing. And the reason why we do that is because if we try to buy something that is 80% occupied, we can't get Fannie Mae or Freddie Mac to even look at it. So for us, it's safer, it's easier to just let Fannie and Freddie take care of it. But if you got into a situation where it was lower than I wanted, what I would do with the seller is let them know that we can just do a master lease option. Give them an opportunity where we just pay them a certain amount a month, every month, for a period of time until we reposition the property where it's 90% occupied, and now Fannie and Freddie will look at it. Does that make sense? Yeah. Okay. All right, and then loan assumption is something that we just did on this 83 unit. Once you get into larger multifamily buildings, the loans are usually more assumable. Sometimes you have to pay points, and that's okay, but on this one, we got into it, we assumed a loan that was already in place. We had to qualify for it, but we didn't have to go and start a whole new process, okay? So here's a few ways, and then this is the part that I was really excited to share with you guys today. is all of the other ways that you can do this, and it's all through strategic partnerships, because you've got a skill, you have value. Every single person has something that they can bring to the deal. And here's a small example. Actually, there's more than this. Here's a small example of some of the things that you can do to get into large multifamily right now today, instead of waiting 3 to 5 years. Okay. So one is OPT. So you can leverage other people's time. How many of you have a full-time job? Please raise your hand. Full-time job. That's a lot of people that are working all day, every day, right? And I do not think that's a bad thing. I actually applaud those people, so give them a round of applause. I think we should stay in our full-time jobs as long as we need to, as long as possible. You don't have to quit your job and rip your hair out trying to do multifamily. You can partner with somebody who has the time, because you have the money, they have the time. You have the knowledge, they have the time. So be able to leverage somebody who has more time to do this, and you'll be able to grow a lot faster. Partner up with somebody. Rather than saying, I can't, say, thank you. Experience. I use OPE myself, and I think all of you guys should use that. And what this is, it's different than knowledge. Knowledge is one thing, experience is a total other thing. So the experience is when you're talking to a bank. If you personally haven't done 1,000 doors and you're trying to buy a 1,000 door property, the bank's going to look at you and laugh. But if you say, me and my partner who have 1,000 doors together are doing this, the bank is going to look at you and give you tons of money for 1,000 doors because you have the experience. Do you have to have the experience? No. But you have to just bring somebody who has that experience. So when I bought the 83 unit with my partners, we brought in an experienced partner, somebody who had done it before, who was able to sign on the loan, and we were able to get a Fannie Freddie loan at a very low interest rate. Then OPL, other people's liquidity. Who's heard of OPM? Raise your hand. OPM, what does it mean? Other people's money. What's other people's liquidity? Readily available money. So if I bring in a liquidity partner, do they have to put a dime into the deal or not? No. A liquidity partner is just somebody who has a ton of money in the bank and is willing to sign on the loan and say, if something went wrong, we'd be fine. Other people have to put their money, but the liquidity partner, they have a choice that they usually don't. Other people's credit, obviously, the bank wants you to have stellar credit, and they don't want a lot of horrible marks on your credit. But even if you do, you'll be totally fine because you partner with a credit partner who doesn't have those things. Other people's knowledge, so this is different from experience. Like I said before, you're going to need to have somebody who's driving the bus. The experienced partner doesn't necessarily have to be driving the bus, they just have to sign on the loan, but you're going to want somebody who has the knowledge and has been there as well. But these are definitely separate things. So make sure when you're looking at it, right now you're looking at it that these are totally different things to be brought to a table. Somebody has to have knowledge, somebody else has to have experience. One's for the loan to qualify and the other's for the bus to be driven. Other people's money, obviously on this last deal that we did, there's a lot of our investors that are in this room right now. We brought 20 different partners. 20. I wish it was like some odd number, then you'd believe me more, but it was 20. And each of these people put an average of maybe $50,000 to $100,000 into a deal where we needed to raise $1.3 million. You can find these people, and the drawbacks for other people's money are sometimes somebody who can talk eloquently about the deal. Sometimes it's somebody who has enough people to understands enough people. I think I'm saying that wrong. Somebody who is involved with and has a lot of friends and family that they can talk to. Other people's network is the same thing. Like if you don't have the money and you don't have a friend who has the money, that's okay. You go get a friend who has the network with somebody who has the money. Does that make sense? Yes or no? Does that make sense? Yes or no? Yeah. Thanks, guys. Other people's relationships. So that's very similar to the network and the money. But again, there's a lot of types of relationships that are beneficial for you, and they don't all have anything to do with money. Money is the smallest and easiest part of this whole thing. What's the money? The smallest and easiest part of this whole thing. So don't worry about that anymore. Right now we're talking about other people's relationships because you're not going to close a deal unless you have credibility. So I wanted to put OPC twice on there, but I thought that wouldn't make sense, right? So other people's credibility, I just went with other people's relationships. So I have a podcast, I have a YouTube channel, I've got a large network for meetups. I am advertised on Joe Fairless's podcast. I'm being asked by people like Rod Cleef to come and speak and present at his boot camp. So stuff like that, if you have somebody else that does those same things, you want to latch on to them, because somebody with those relationships, guess what happens when I try to put a property under contract and I've never closed on an 83 unit before. They look up my name, they find out that I have a podcast, they listen to the podcast, and it's immediate credibility. So it helps a lot to have a credibility partner, whether it's me or anyone else. You can find that person. We've got Michael Blanc, we've got Joe Fairless, we've got Rod Cleef, we've got, who else did we miss? Brad Sumrock. Good deal. Okay, so does everybody understand this? Okay, we are nearly done with all the education, so don't worry, we're nearly done with the education. I will answer questions for the 6 properties that I bought. So if you guys have certain questions about the 6 properties that I bought, they were all done creatively, and 5 out of 6 of them were done out of state. One of them I managed out of state after I bought it. It was in Utah, and then I moved to Florida. So, want to learn more about multifamily? Here's one resource. Write it down or take a picture. If you want to learn more about getting into multifamily, Denver Apartment Network, DAN. I don't know if you can see this because it's not blown up very big, but it's just meetup.com/DENAPT-network with little dashes. So if you want to find out more about that, these 2 in the back right here with the blue spruce shirts, and this guy with the camera over here with the blue spruce shirt, they know all about Denver Apartment Network. Join it, come anytime you want. Then if you want to learn more about creative strategies, we have the Creative Real Estate podcast, and we have the Creative Real Estate Lunch Club. The Lunch Club meets every single Thursday at noon. Every single Thursday at noon, and we've been skipping. We've been doing 51 events per year because of Thanksgiving. I think we're going to do some volunteering this Thanksgiving, so we're getting back to 52. And then the Creative Real Estate podcast, just look it up. You'll be able to find it pretty fast, pretty easy. And we interview a ton because we're syndicators ourselves. I have a lot of apartment syndicators on the podcast. But the entire information that goes onto that podcast is all about thinking outside the box. So we don't even want to have a box. I want to blow that box up because there's always a way to get something done. So always say, instead of like, I can't, just figure out a way, how can I? And then want to drastically grow your network, don't worry, I have a book. So you don't have to buy it, I don't care if you buy it or not. It's only if you really, really want to grow your own network, because I promise you, if you're being a syndicator, you will find benefit at least if one person on your team is doing the type of stuff I'm doing today, okay? If at least one person on your team is doing this type of stuff, you're going to be a lot more successful. So whether that's you or where you partner with somebody who is doing this kind of stuff, you're going to be of benefit. So you might want to read that book and hand it to the youngest whippersnapper that loves people and gets along with people, and just say, hey, go take off. This book is gold. I think it's worth at least 100 times the 20 bucks. And then there's an event this Thursday, and we have 4 out of the 10 top meetup organizers through the state of Colorado that are going to be presenting. And so you can come and do Q&A with them. If you want to come, just look up the lunch club that I told you about before. But if you're working or you need to grow your network so that you can do syndications like we're doing, you're probably going to want to try to come on Thursday and ask questions specific to what you need to know to 4 of the top organizers in the entire state, so that you can benefit by growing your network. And then I've got number 3 is we've written the top 6 things. So it's not a whole book, and it's not $20, and it's not 2 hours out of your day. If this is just real super easy for you, you just text the word meetup to 555-888, and that'll at least give you the 6 top things that I did to grow my meetup to be the #1 biggest meetup group in Colorado. One of the top 150 meetups in the entire world out of 8 countries. So if you guys want help with that kind of stuff, please let me know. And then questions. So on any of the seller finance, seller carry, master lease, loan assumptions, the 6 deals that I've done with none of my own money or credit. Actually, I think one deal I had to sign on, actually. The 16 unit, it was $1 million loan. I think I did have to sign on that. And then resources, if you have any questions on the resources, please go ahead and ask, and I will repeat your question to make sure everybody hears. Who's first? Pat, you had so many questions yesterday. All right, right here.
Are you interested in investing in building apartments?
I'm not interested in building apartments myself. My company focuses only on cash flowing assets that are 90% occupied or more. That's our only focus. There is, in our opinion, don't take this to the bank, in our opinion, there's a little bit of risk by building an apartment because I don't know what's going to happen with the economy. But if I have 2 years of history showing what the cash flow has been in an area, and I can show that it's growing 2% year over year, and it's 90% or more occupied, it's very easy sell for my investors, and I feel confident that I'm going to be able to pay them back. If I go to something like a total huge reposition or a brand new apartment complex, to me, that's all speculation. And it could literally be the biggest payoff for them ever. Maybe they'll quintuple or 10 times their money in a year or 10 years. Just for us, it doesn't feel right now. So, other questions? Pass?
So what would be the benefit? Let's say somebody has $100,000.
Yeah.
And they're thinking of going and buying $10,000 to $30,000 properties out of state.
Yeah.
Versus, what's the benefit of investing in passively into an apartment syndication?
I love that question, and there's 2 huge ways of thinking, and the biggest thing that it matters. He's asking, if you've got $100,000, I think he said, should you buy a few really cheap, huge cash flowing assets out of state in a high cash flow market, or should you be passive? And the answer is that it totally depends on where you plan to go. So it's your goal that needs to be in mind. If your main focus is to be completely passive and never stressed out about if a tenant misses a late payment or if you have to replace a roof, then there's an obvious one way or another. Because if you have a full-time job and you own a few houses in Ohio, I think I have 12 properties in Ohio right now, and a bunch in Missouri, some in Connecticut, some in Tennessee. So like, I like out of state, and a lot of mine, I have about a dozen, we have about a dozen single families. Most of those are out of state. I bought 3 houses in Ohio for $28,000, not $28,000 each, not $28,000 each. I purchased 3 houses for $28,000. It was about $9,000 a piece. And then I refinanced it. This is all with the creative strategies, right? I refinanced them. And I tried to get a bank to qualify me. I wanted a bank to qualify me, but there's 2 things. I would have either had to pay a crazy amount of interest to the bank and a huge down payment. Just like a loan origination per house was like $3,000 or $5,000. It was ridiculous for that type of price, right? So what I did is I got a private investor, gave them 12% on their money, refinanced it out, not for $28,000, but for $45,000. So I put like 7 or 17. I put some money in my pocket, and I still make a ton of money on those, and I like it. I like out of state, but it's a lot more work than just totally being passive. If your goal is to be a multifamily syndicator, I'm glad you asked, because this is huge, guys. No bank, no seller cares how many single families you've done. Does that make sense? They don't. If you flipped 100 or 300 houses, if you have 30 rentals across the United States and you're trying to buy a 40-plex, you can't do it. You can do it with strategic partnerships, like we were talking about before, but the bank's not going to do it. But if you invest passively into somebody's 100-unit property, then you at least have that experience and that track record that will allow you to get a lot better. So depends on what you want to do. If you want to be completely passive, be completely passive. If you want to eventually be a syndicator, get into apartments, get out of houses. I would say if you really truly want to do this, honestly, fully want to do this, I would stop the focus on single family and immediately switch to multifamily because you'll be retired in 1 to 2 years after the first deal. What other questions? Please.
How do you decide how long you want to hold the property and when do you sell?
I don't decide. My engineer decides. So we have an underwriter who takes the time and to understand the market. We have a market analysis person and underwriter that takes time understanding what's happening with the market, what's happening with the property, how much capital expenditures it needs, how long everything that's in there will last, what's been happening with the market, and then they decide that when is the right exit point. And the best exit point is when you basically double your investor's money. The best exit point is when you double your investor's money. Some people can do that in 3 years. Some people can do that in 10 years. And it's a lot about the property. So when you see an opportunity to return capital, you want to give them their money back as soon as possible. Because what's going to happen, and like I said, there's a lot of our investors that are in this room. If I give them their money back early, they're going to be like, where's the next deal? I don't want this in my bank account. So you immediately return it. And if you return them less than that, it's not going to help you either. So you want to look at that sweet spot. And there's a lot of little factors that matter. And there's the two that I want to mention to you is this. Number one, there is a cycle of the market. There's a market cycle. And you buy here and you sell here. You buy here, you sell here. And not every market's doing this at the exact same time. They're kind of doing this, right? So you sell, buy, you know what I'm saying? So that's the first thing to think of is once you're up at the top, just get out and go to a higher cap rate area while that's appreciating and becoming a lower cap rate area, which means more expensive. Kim kind of covered that earlier. And then you'll exit. The other cycle that you want to look at is your building cycle. And the things in your building only last so long. So you want to get out before you have to put in capital expenditures and let that second person, your buyer, come in, put the CapEx in, and do something nice for their investors. Make sense? Any other questions? How much time do we have? What time is it? 12:45. All right, 3 more questions.
So, what's your next deal?
Don't know yet. We only go for deals that work, and we don't have one in the pipeline today, but if you're interested in joining us on one of them, just come and talk to anybody with a blue spruce, get our card, and we'd be happy to put you on the investor list.
So I got another question. You brought it up, one of the ways to team up is through earnest money deposit.
Yeah.
And if you give the first right of refusal for a general partnership, I was just wondering if you could go a little deeper in that. And what is an average earnest money deposit for
Average earnest money deposit for us is probably under $100,000. Okay, so anywhere from 30 to 100. So that's why I used the number 50 before, because it's very in the middle. And earnest money for us is typically 1% of the purchase price. So whatever we're going to buy that for, let's call it $5 million, then it's a $50,000 EMD. Does that make sense? And your second question was, how does it work for that partner who wants to do that? Is we give them a promissory note, and so it's attached saying, we're going to pay you your money plus interest back, and these are the terms. And again, we need to talk about this and negotiate it, but that's number one, is setting up the documents so that we can do it, and then we borrow the money, put it down, it keeps us liquid, and so it helps us a lot. And then once the property is about to close, when we're raising money, you say whether you want in or whether you want your money back plus interest. And if you say, and if we don't close, you get your money back plus interest. Does that make sense? So the money's safe, it's attached to the property, it's not going anywhere. So you either get your money back plus interest, and it's usually 10-ish%, or you get first right of refusal to say, I want a small part of the general partnership. And again, that has to be negotiated specific to that property, something that makes sense for you and us.
So if you get a part of the general partnership, then you keep your money in, it doesn't come back out.
Exactly, you keep it, well, negotiable. Yeah. All right, 2 more questions.
The other people's, all those other things you're talking about,
Okay, so if you don't have money, but you have time, you have to bring something to the table. Like, I have time to go and network with a lot of people. I have time to look for the deal for you. I have time to underwrite the deal for you. I have time to manage the property after you purchase it. Either way, if you have more time, you have to come with one of those other things and do both. You just can't have just time. It's time with value of something to bring to the table, like underwriting the deal, finding the deal, finding investors for the deal, speaking at events like this, or I think I missed one or two, but there's a lot of options if you just have time. There's tons of options to do this stuff. One more question, and then we'll wrap it up right here.
Can you give us a sample of a deal?
Oh yeah, the sample of a deal. So let's use the 83 unit that we just closed on because that's bigger and more impressive. All right. So on the 83 unit property that we just closed, the purchase price was $3.9-ish million, 3.9. Then our loan that we assumed was 2. He's an engineer. He can't just say 2.6. It's 2.67, and I'm sure he wanted to say all the other numbers after. So we close on a property that is 3.9. The loan is 2.67, and he was trailing off. And then the other things that need to be involved in that is raising the money. So the money that we specifically raised to do this deal was just under 1.3. And actually, we had some struggles raising the 1.3. And most of that was things that I could teach you one-on-one on what not to do and what to do, what to assume and what not to assume, because I've personally I repositioned a property in 2007. I bought my first apartment in 2008. I own 100 plus doors right now. And what that means is I can't always say the things that other people want to know. So I spend time like asking you until I can get the pitch right so I can answer your questions. And so raising the money is something that is going to be tricky. You want to have somebody on your team that can do that. Other parts to that is managing the deal. So on the 83 unit, we actually have a staff person managing that deal that lives at the property. So you can have a third-party management company, you can hire a big company, and we do a variety of these things. In this case, the person who was managing it before, we just hired them and put them on our staff. What other parts am I missing on this deal? See, because I don't always know what to answer. So what questions do you have? And I'll finish with Dave.
Well, how long did the whole process, how long
Okay.
from beginning to end did it take?
That one was probably 3 months from LOI to close. What was it, Brad?
Well, it was 4, but we had a
4?
re-inspection built in.
Okay. All right, so this was 4 months, and the beginning is your belief system. The beginning is believing you can do this and that you're not going to wait 3 years. That's step 1. Step 2 is knowledge, learning this or teaming up with somebody who already knows it. Step 2. Step 3 is to put in offers, a crazy amount of offers, a lot of offers. And these are called letter of intent. And so it's kind of a technical way of saying these are the details we like, and you put in the LOI, and then they can either accept it or not. Once you have an accepted LOI, then it goes to having the attorneys draft a contract for you. Okay, so the attorneys drafted this contract after the LOI was accepted, and then we go and start looking at the property, and there's a few things that you have to do to underwrite a property. One of the first ones is to double check the numbers and get bank statements and get bank statements and get bank statements to underwrite the deal and get what?
Bank statements.
Why would you get bank statements?
Proof.
You have to really know. They can write anything they want, but it's only real if you see the bank statements. Okay, so you get bank statements, and then you do what's called a phase 1 environmental study. So they come and check to see if there's anything bad on the property, in the soil. So that's the next thing, because you don't want to buy something not knowing that. And so then you close, then the next step would be to fly out there. So for us, we don't even go out there until most of this other stuff is out of the way. We don't want to waste our time quite yet. We go out there, we meet a bunch of property managers, call 3 property managers, how many?
3.
Call 3 brokers, how many?
3.
Call 3 appraisers, how many?
3.
And call 3 something else, I'm forgetting it. So then you go out there, you bring in your team to look at all the properties. You'll go first, and if the seller lied to you, you haven't spent too much money yet. You go first, and if the seller lied to you, don't worry, you haven't wasted a bunch of money on an inspector inspecting 100 or 83 different units. What's the next step, guys? What's the next step? So after looking at the numbers, getting bank statements, now and then doing the phase 1, then doing all of your inspections on every single unit, paying for that, you look at it, and then retrade. The next step is to retrade. Retrade is a technical term for renegotiate. So then you take time to kind of look to see what your numbers are coming out at, as far as looking at the property, how much it's going to take you in capital expenditures. CapEx means the initial things you need to do for expense to make that property in livable, great condition in the very, very beginning. There's maintenance along the way, but CapEx is like the upfront stuff. And once you figure that, now you're retrading, you're saying, I need you to carry back a note because of this. I need you to lower the price because of that. I need you to do, trying to think of the term, sometimes I forget words, and this word is concession. So you ask for a concession. I'm going to have to do the roof, so you need to put 89 grand into the bank. Leave it there. I'm still paying the same price, but that roof is coming out of your pocket because that keeps the cap rate exactly at my minimum is what I'm allowed to buy it. So you retrade, and then once all of that's good and it's solid, now you start to raise money. But don't take that technically because you should have started raising money months ago. But now you start to go to your people and do what, here's the other thing that I didn't do that you should do. Get a fake deal. Get a pretend deal. Real deal, but it's not your deal. And you go to this person, you say, hey, when I asked everybody to raise their hand if they had 50 grand or more, you raise your hand. What happens if I did this, 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 and this, and it worked out like this? Would you be interested in something like that? If he says yes, say, great, I've got you down. When I have a deal like that, I'll bring it to you. When I have a deal like this, I'll bring it to you. It is so much harder to go up to somebody and say, I've got a deal right now, do you want to invest in it? Than it is to start out by saying, here's something that I'm working on. If it looks like this, would you be interested? Yes or no? You're probably going to get a lot of yeses. Then you say, hey, remember that thing? I have something exactly like that today. And then the next thing after raising the money is, you got to get the private placement memorandum put together before you raise the money. So that's step 1 of raising money is a PPM. So we use Jillian Sedoti. You can use anyone that you want. Jillian is our attorney, and she is a SEC securities attorney. She'll put together a huge packet. A lot of people in this room saw our packet. What was it, like 80-something pages? Anyway, the attorney puts this thing, and it says everything that can go wrong, and then you have to let your investors read that. Then the next step would be you got to be starting to qualify for loans. So you're talking to banks. You got to talk to at least one loan broker. Raise your hand if you're a loan broker. Stand up if you're a loan broker. You have to talk to at least one loan broker, minimum, and at least 3 local banks in that area, for sure. And now you start to understand what you can qualify for, because sometimes the local banks who know the area and love the area will give you a better rate than the other people that are traditionally like nationwide, if that makes any sense. And then you finish raising the money, you start an LLC, the money goes into the bank. All of that money that we collected, the 1.3 million for our last deal, all of that got collected, put into the bank. When it was all there, then DJ, who's on our team but not here today, DJ ran to the bank, wired the money to the title company, and we close like an hour later. That's the whole process, except now we have to manage the deal to make sure our investors get their money back. So, all right, thank you. Oh, okay.
Just a real quick, what made this deal worth buying?
Okay, so there's a few things on this deal that we really liked. Number one is the area. The area right now currently is getting a lot of attention from huge investors. So I told you that I like education. I'm not an educator. I'm not trying to teach you or charge you. I'm saying you probably should. Number one is my education for tax liens and tax deeds from USTLA, a $40,000 education. All of those hundred multi-millionaires are now looking at Branson. I like that. Number two, at our apartment investing education, another $40,000. Many of the higher up multi-millionaires who are starting to look for new areas like this. So it took our attention there. Another one is we like the cap rates. So the cap rates currently are supposed to be 7.5 to 8, an 8 cap. So we like buying things with 8 caps because it means we can give our investors a certain amount of money, a certain return. So a cap rate makes a lot of sense to us. I personally, there's syndicators that buy in New York with 2 caps, here with 4 caps. There are syndicators that are doing this, but they're not able to pay their investors like on year 1 usually, okay? I want to be able to say, I got you a certain amount, and it happens literally 3 months from the day we close. On the first quarter, you're already getting paid. So we like the cap rates. We like the attention that the area is getting. Currently, that specific area has been growing 1% to 2% since 2008. So we like 2 years in a row of 2% growth, okay? 2 years in a row of 2% growth. This has had 1% to 2% for several years. The next thing that we like about that area is they have about 9 million visitors every year, okay? Last year they had about 9 million visitors, and it's a smaller town. What I love is that the local city, so we talked to the Chamber of Commerce, write that down. We talked to the city planners, city building department, and you ask them questions like, what's happening here? And when we did that, they were saying that they're offering incentives to new entrepreneurs to come in and not just market to the tourists, but to market year round. Okay, so we love that about the area, is that not only do we have 2 solid years of awesome numbers at that building, and it's getting tighter and tighter. I'll tell you a little bit about that in a second. Not only do we have awesome numbers at the building, but the city is incentivizing people to do things for year round, and we love that. It is currently one of the most economical, most affordable places in the country to be able to live. It has a very nice level weather pattern. So with the weather, it's attracting a lot of retirees and to stay there long term. And finally, what I was going to say about the building is that we have, the last couple of years have been so steady. The numbers have been extremely, extremely steady for us. And what is happening is at 95% occupancy, 5% vacancy rate. Currently, we're at 0. We're at 100% occupied. So what we're seeing, because we're at 100% occupied with a historical occupancy of 95, that shows also to us that the area is in high demand for apartment buildings. We want to have an apartment building where the area has a huge demand for it, and you have high occupancy like that. And then there was one other thing that I was going to mention to you, and that's that they put in $2.5 million of capital expenditures in 2015. So back in 2015, they rehabbed the whole dang place. It's not even an old place. It was built in the late 90s. And then they rehabbed it completely just a couple years ago. So that means we can come in without CapEx. All of the coolers are new. All of the furnaces are new. Everything's brand new. So we don't have to worry about when those are going to go out, because we're going to be exiting way before that. Anyway, those are our main points. We've got to wrap it up. So Pat, last question.
Where's it at?
Branson, Missouri. So one of the
cowboy capitals of the world. They call it the Christian Las Vegas because they have a strip, and our property is right off the strip. Thank you so much. Thank you for being here. If you have questions, holler at any of us. Kim, thank you.
Yes, I did.
Turn it off.